Hi, it's Mo and welcome back to the property vlog. This week, our £500,000 down valuation. So as many of you will know, we have a multi-award winning project, Wyndham Hall. This is a former non-conformist chapel that we converted into 30 HMO rooms split across 6 flats. I've done a video talking all about this project, which I'll link to up here. So I want to take you back to January of 2020. I don't know if you can remember a time before COVID. January 2020, I was relaxing in South Africa on honeymoon, and I get an email to say that the refinance valuation for Wyndham Hall has come back £500,000 less than we were expecting. So we wanted over £2 million on the valuation. Worst case scenario, we thought we would get 1.9. That's the value that we had when we went into the project, and that's the value, the RICS value that Crowd Property used to lend against the project for the development. So I'm on honeymoon and I get the email and I see valuations come back from the valuer for Wyndham Hall at 1.4 million. And honestly, when I read that, I thought it's just a typo. I was like, brilliant, we've got the 2.4 million that we asked for. Obviously you have to go punchy when you apply for these refinance valuations. Went for 2.4. Were seriously expecting it to be over 2, came back at 1.4, and I just looked at it and thought, it's just got to be a typo. So I called the other directors to confirm, and unfortunately it wasn't a typo. So despite the valuer saying before and during the valuation how impressed he was with the build quality, the quality of the finished product, the fit out and everything like that, he just said he couldn't justify such a high average rental figure in that area. So we had great room rate comparables in our portfolio. This project was slightly outside of where the rest of our portfolio was, and the average room rates were a bit lower, and as such the valuer didn't think that we would achieve the values that we said we would. Okay, so let's pause the video here and talk about how a building like this is valued. So a building like this is not going to be valued on something called a bricks and mortar valuation. So they're not going to look at sort of like flats and houses in the area to work out what the building is valued based on. A large, unique, income producing asset like this is always going to be based on something called a commercial valuation. So let's talk about how a commercial valuation is arrived at. So first up, they take the aggregate gross rental income. So if you've got past performance, they'll look at that and say, okay, this is the aggregate gross rental income. If you haven't, they'll take an average room rate and multiply it by how many units you have to arrive at that sort of aggregate gross rental income figure. Then they'll make some allowances for costs based on certain assumptions. Different valuers will calculate the costs assumptions differently, but they all take into account things like repairs and maintenance, operating costs, voids, utilities, all those kind of things. And some of them will lump them all together and use a percentage. Some of them will use like a £1 per week per room figure for costs, and then look at some other things for sort of maintenance and voids. But they all arrive at an assumed figure for how much the costs to run the asset are going to be. Once you take the aggregate gross rental income and you take away the assumed figure for running costs, as I've said, however they come to that figure, that will get you to your net return, and that figure is then used with the investment yield to give you the value. So the investment yield is then applied to the net rental figure. So the investment yield will be based on the type of asset, the market, things like that. So typically we're looking, where we are in Plymouth, we're looking at sort of 8 to 9% as the investment yield. And if you reverse engineer the investment yield 8 or 9%, it will then give you a multiple. So you can then multiply the net rental income by the investment yield multiple. So if it's 8% or 9%, it'll be somewhere between like 11.1 and 12.5 times the net rental figure. And that will give you the valuation. So the key levers that you can pull to influence the valuation are: number 1, average room rates. You want these to be as high as possible. Number 2, running costs. Number 3, deductions for repairs, maintenance and voids. And number 4, investment yield, or reverse engineered the multiple that's applied to the net rental figure to give you the valuation. Okay, let's jump back to the main video. So the reason for our down valuation from 1.9 million to 1.4 was a combination of things. Firstly, the investment yield used was 9% rather than 8%. And also the average room rate used was lower as well. So the investment yield going from 9 to 8 actually then makes the multiple effectively of the rent go from about 11.1 to 12.5 times. So quite a significant sort of difference in the multiplication factor there. Combining both the lower room rate and the difference in the investment yield actually then resulted in the £500,000 down valuation. So safe to say we were devastated with that news, but we sort of focused on what can we actually control and what could we actually do now. So option one was, can we appeal it? You can appeal valuations. You typically, if you're successful, you'll only get a slight change to the valuation and it'll sort of be tinkering around the edges. So it's generally not worthwhile. We also had to get off the crowd property development finance, which was more expensive than what the refinance interest would have been. So ultimately, we just didn't see that that was a viable option, and we didn't think we'd get much of a change anyway, even if we pursued that. And it would just take a long time. All that time, we'd be on more expensive crowd property debt. So option two, the main thing that we could do was really just get our heads together and focus on a refinance down the line. The valuer gave us some good feedback in terms of actually down the line, 12 months or so, if you can prove that you're hitting these average room rates, we can support a valuation sort of around about £2 million down the line. We just knew we had to focus on getting 12 months of performance to show that we were hitting those higher average room rates. The next thing we had to do was actually just speak to our investors. So there were investors that were expecting to be paid out. We had loan agreements in place that sort of expired at the point at which we got the refinance in. So we had to have a conversation with those investors about extending terms. Thankfully, we have a really good relationship with our investors. We've got a really good track record with both our investors that invest through crowd property and also that invest directly with us. So we renegotiated terms for extensions, paid interest up to date, and just basically rolled into a new agreement to give us that time to show the performance of the asset so that we could get the higher refinance value down the line. The other thing to note on that is also that we actually had really good positive cash flow from the asset, so we could afford to service the sort of more expensive debt for a longer period of time to sort of allow us that time to build the case for refinance. And then March 2020, bang, straight into COVID lockdown. So we'd started to get the occupancy up, having launched the unit onto the market in like December 2019. So we started to get the occupancy up, and then COVID hit. So we pivoted, we moved some of the flats to just be exclusively for NHS workers and key workers. We lowered some of the room rates, we did shorter contracts, we were more flexible with it. We tried to keep people that were sort of working in an environment that could potentially be exposed to COVID, so NHS key workers were sort of living together in units rather than having them spread out across different units. And gradually we sort of got the occupancy up and up and up until eventually we've got it to 100%, and ever since it's been sort of between 95% and 100%. And those lower room rates that we took during the first lockdown and throughout 2020, we started to nudge those up as well as we let them on longer contracts and to not necessarily just NHS and key workers. If they moved out because they were sort of then in a position where they were happy to move back with their families or move in with other people, we released them from their contracts, and then we got sort of longer term tenants in at sort of more of a market room rate, or our room rate that we were expecting to let the rooms at. So roll forward just over a year from our initial valuation, we then got another valuation done. We prepared all our documents, sent them to the valuer. We had the valuer go round, waited with bated breath to see what the valuation would come back at. And then boom, we got 1.935 million, which we were really, really happy with. So that meant on the 30th of November, we got nearly £400,000 into our account from the further advance from Shawbrook. And this was a great result for us. This meant we could repay investors. It meant we could put some money aside for future business operations and stuff. So really, really happy that we got the valuation that we wanted a year ago. But, you know, given the circumstances, we're really happy to get it over the line now. So to round up, some quick top tips from experience. Number one, understand the valuation methodology. Is it going to be valued on a bricks and mortar basis or a commercial basis? Number two, heavily sensitize your rental figures and also your other costs. So rental figures, bring them down, sensitize them by 20%, 25%, whatever you think. And operating costs, sensitize them the other way. So put them up and assume they're going to be more expensive than you think. Number three, have contingency built in. So think about the refinance taking longer and also coming back at a lower value. So think about how you're going to work with your current investors. Think about how things are going to work if it takes longer, you get a lower valuation, and have that contingency plan built in, almost expecting the down valuation. Number four, nothing beats actual performance that you can evidence. If you've got ASTs at a certain level, if you've got operating accounts that you can show, this will really support your valuation. If you haven't got that and you're really smashing the sort of average price in the area for a room because you're providing a great product and great service, then if you can wait for a year before you do the refinance, great. If you can't, you might have to accept that you're going to get a lower valuation now. Build your sort of track record and show your ASTs with higher room rates, show your operating accounts to the valuer, and then you might be able to get that higher valuation down the line. And number 5, which probably actually should be number 1 because it's one of the most important things, is relationships. So I think there's 2 key relationships that you need, and you should have these in place anyway, but really important to focus on in this scenario. Number 1 is the relationship with the valuer. So get to know the valuer, understand what their valuation methodology is, understand how they sort of interpret what's in the RIC standards for valuations, and they all calculate it slightly differently. So just understand what they're actually going to use to complete their valuation work, and also just have a good relationship with them. You know, if they know you personally, then they're more likely to give you a favourable valuation within the sort of remit of the RICS methodology. And also just provide them with, if you know how they're going to calculate it, just provide them with as much evidence. You're trying to make their job as easy as possible, and trying to, the easier you can make it, the closer their value will be to what you want it to be. If they've really got to look through loads of documents and try and work it out for themselves, it's unlikely it's going to be close to what you want. So really make their job easy and have a good relationship with the valuer, number 1. And number 2, investors. You should always have a good relationship with investors, but obviously it's even more important if you come to a situation where you can't repay them, or you need to extend terms or change terms or whatever. Be honest, be open, be transparent with investors, and that will really help if you do get a down valuation. So thanks for watching. If you have any comments, please leave them below or send me an email or a DM. I'll put my details below. And if you like the content, please remember to subscribe and also like the video, share it with anyone that you think might get value from it. So thanks for watching and see you next week.